This is Dimitri Lascaris reporting for the Real News Network from Montreal, Canada. Last year, major Exxon shareholders BlackRock and Vanguard backed a proposal requiring Exxon to provide analysis of how climate policies will impact its bottom line in an increasingly warming world. Now, ExxonMobil has issued a climate impact analysis for investors. According to the company's report, 2018 Energy and Carbon Summary on Positioning for a Lower Carbon Energy Future, world demand for oil could dip substantially by 2040 if policies to curb warming are aggressively implemented. So, is a transformation afoot in the world of finance? Is the market becoming increasingly concerned about the overvaluation of fossil fuel assets? With us to discuss this, I am very pleased to be joined today by Anthony Hobley. Anthony is the CEO of London-based think tank Carbon Tracker. Carbon Tracker carries out in-depth analysis on the impact of the energy transition on capital markets. Thank you very much for joining us again, Anthony.
Oh, it's a pleasure. It's great to be here.
So the last time I interviewed you, Anthony, I believe was when we attended the UN climate conference COP22 in Morocco in 2016. And
Right.
in your view, has the attitude of investors toward climate risk changed much since COP22? And in particular, are investors showing much greater concern about climate risk disclosure?
It certainly has. I mean, there's real momentum behind this now. I mean, this started obviously with the work that we did. I mean, that's been picked up by people such as Mark Carney, the governor of the Bank of England, but also chair of the G20's Financial Stability Board. And a game changer was the creation of the Task Force of Climate-Related Disclosure. That's great in itself, but the fact that major financial institutions are getting behind this, such as BlackRock, who've recently written to many of the companies they own or manage shares in, the decision of the biggest sovereign wealth fund in the world, the Norwegian sovereign wealth fund, to consider whether it drops all oil and gas stocks. It's already withdrawn from most coal-related stocks. So we see real signals, real winds of change, and this disclosure is not the normal sort of environmental disclosure. It is really disclosure that has a hard financial edge to it, trying to understand the financial risks of a business as usual pathway. And I think it's no longer in the minds of investors just about the policy and action of government. It's also a recognition that we're in a technology-driven low carbon transition, and that in itself can be highly disruptive.
Well, let's talk in particular about Exxon's most recent disclosure. It paints, I think it's fair to say, a mostly rosy future for the oil and gas industry, saying that even aggressive climate policy poses little risk to the company. However, the report does not address, for example, the multiple lawsuits facing Exxon and other fossil fuel giants. Do you think that this is a realistic analysis of the future and the risk that arises from climate policy? And in particular, do you think that appropriate account is being taken by Exxon of the risks of climate-related litigation?
Well, there's a couple of questions buried in there. My flippant answer would be yes and no. Yes, because I think, like most of the fossil fuel companies, there is now an acceptance of the concept of demand destruction. So the fact that there will not be ever growing demand for their products, and the acceptance that there will come a time where there will be peak demand. We used to talk about peak supply, but actually I think what's more realistic now is peak demand. I mean, as we know, fossil fuels have now lost their monopoly on energy generation. They're facing competition from ever more efficient and cheaper alternative technologies, and that's eating away at demand for their products, as is a drive towards energy efficiency. Where the blue water exists between us and the likes of Exxon is how quickly we arrive at that point of peak demand. We did some modelling with Imperial College here in London in our report, around the disruptive power of new technologies, and we felt even with relatively weak climate policy, and we looked at different weak, medium level, and strong climate policy, there is still massive amounts of disruption from the emerging technologies of wind, solar, battery storage, electric vehicles that the companies have to respond to. If the companies respond and they accept that this is happening and they need to go X growth and recalibrate their business models accordingly, they can actually create a lot of value as part of the transition. But if they deny that or get that wrong and continue to expand and develop resources we simply don't need, they can destroy a lot of value, as many US listed coal stocks have done over the last 5 or 6 years.
Let's talk about another technology, one that Exxon's analysis seems to place a great deal of stock in, and that is carbon capture technologies. Mm-hmm. Do you think it's a reasonable assumption that those are going to develop quickly enough and effectively enough in order to preserve or prolong the viability, the sustainability of fossil fuels as a major source of energy for the world? What do you think the current state of that technology really entitles us to expect about the future?
Very little in the energy sector. I mean, it is a massive red herring. And what is frustrating is the way in which many companies use that to imply that there is a magic bullet. There isn't. Even if we develop carbon capture and storage, CCS, at the levels predicted in some of the more optimistic scenarios from the IEA, the International Energy Authority, that is still only around 14% of the overall carbon budget, buys you about 14 years breathing space. It is not a panacea or a solution. And that idealized scenario looks at several thousand commercially operating CCS facilities by 2050. That would mean several hundred a year being built, opened, and operated between now and 2050. How many commercially operating CCS facilities do we have at the moment? We have a number of pilots, but no one has actually got a single facility to the commercial stage in a commercially operating plant. It is certainly not too late for coal, and it doesn't really hold out much hope for gas. And what's also, I think, very dangerous about CCS consuming all of the oxygen in this debate is, under every scenario, and 2 degrees, 1.5 degrees, etc., we do need negative emissions. No one, I think, is arguing about that. But the debate around CCS is stopping us having a debate about where we get and where we can most effectively get those negative emissions from. For example, investment in land use change and forestry, and avoided deforestation, and REDD+, for example.
We have wonderful technology provided by nature for negative emissions, as you've indicated.
Which has been millions, if not billions of years in the making. And also, humans have developed structures, commercial structures, and regulatory structures to develop those. I mean, it's called REDD+, and there's a very robust regulatory regime around that. And it, per ton of carbon captured, it's significantly cheaper than CCS. But I guess for many people, it's not a big, sexy engineering project. And that's quite often what seems to count against it, even though that doesn't make logical sense.
Right. And in responding to my last question, you mentioned the state of the coal industry briefly. Donald Trump, as I'm sure you know, campaigned on a promise to bring back coal. Globally, is there any evidence that, in fact, coal is making a comeback after the election of Donald Trump?
No. I mean, it'll probably slow down, make the death of coal even more painful and elongated, but it's not going to stop it. We've done 2 recent coal reports, one looking at coal-fired generation in the United States, no place for coal gen, and we did one in Europe. In both of those reports, we show that the majority of coal-fired generation is having to operate at a loss and effectively be subsidized. So in the United States, 78% of coal-fired generation is now having to be subsidized by the US ratepayers to compete with clean alternatives. So US energy users are paying effectively a subsidy through their energy bills to keep that coal going. And of course, they get additional benefits like pollution and climate change and so forth for that subsidy. That could be $10 billion a year by 2020. In some US states, that could be 10% of the energy bill. It's not quite as bad for coal in Europe at the moment because, unlike, we have very liberalized markets. In the US, it's very regulated, but it's about 59% of European coal-fired generation is operating at a loss, and the rest is probably will be at a loss by 2030, 2040, and is marginal at best. So, and it's quite an interesting paradigm shift because, for many years in my career, arguing about renewables, the retort has always been, well, renewables only works if it's subsidized. Well, we've reached a point in many cases where coal only works if it's subsidized.
Well, this has been part one of our discussion with Anthony Hobley, CEO of Carbon Tracker, and thank you for joining us today, Anthony.
You're welcome.
And this is Dimitri Lascaris for the Real News Network.